Hello and welcome back to Simple Money Podcast, Canada's own personal finance podcast, presented in short and informative episodes. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. And today we go deep into the psyche of us, humans, where we look at the major types of cognitive biases that affect our personal finance and investment choices. These internalized decision-making techniques can seriously affect our financial choices, for better or worse. And understanding them can give us greater knowledge of our own behavior and why we make certain decisions. So cognitive biases are often defined as a tendency, prejudice, or inclination towards or against something. They are deviations from the norms or rationality of judgment and create our own subjective reality. Biases can be positive, such as a habit of avoiding sugar or something dangerous. They can also be harmful, such as a prejudice against certain groups of people or other harmful behavior. Cognitive biases are essentially mental shortcuts that are based on existent or pre-existing beliefs that are often not rooted in knowledge. This can then lead to unreasonable or inaccurate conclusions. In some cases, biases can come from heuristics. Generally described, heuristics are a mental rule of thumb that we have developed over time to assist with problem solving or analysis. These are essentially quick rules that can help us navigate frequent decisions without having to put the energy into making a detailed decision again. They can be handy when it's a simple issue like what you should wear for the day or what to have for lunch, but they can be damaging if they lead you into repeated errors. And this all circles back to how these types of behavior can really affect how an individual manages their finances and invests. Traditional economic theory assumes that individuals are rational, have access to information, and make consistent choices. However, a growing amount of research into investor behavior indicates otherwise. One of the most common types of biases come from chasing trends, basically just investing in what everyone else is doing. On the surface, it seems like it's the right behavior because it's working, and we don't want to miss out. There's also the peer pressure influence as well. Unfortunately, what often happens here is that one shows up to the party late, and performance of these trendy investments are lacking. Research on behavior finance found that 39% of new money contributed to mutual funds went into the 10% of funds with the best performance over the previous year. And additional research from the University of California found that investors who based their decisions on past performance had worse performance than others. And this shows us something that we have seen quite often. As more attention is given to a specific asset, such as a stock, more people jump on the bandwagon. Recently, we saw this happen with cryptocurrency and marijuana stocks. Some people did extremely well, but many were badly burned, and those were usually the ones that jumped on the trend at the end. Another bias that we frequently see is called the endowment bias. The way that this bias works is that an individual overvalues an asset that they own in comparison to if they are buying the same asset. This individual overvalues this asset even if it's irrational. A perfect example of this is when a friend tries to sell you something for much more than it's worth, or if you have ever experienced the joy of a garage sale with overpriced items. From a larger perspective, this can cause an individual to hold on to assets for longer than it is recommended, and in the most extreme cases can lead to hoarding. There's also a risk if the asset's held long enough, it may completely lose its value. In some cases, one may irrationally overvalue investments, leading them to hold on to them for longer than would be typically recommended, causing greater losses and missing out on other opportunities. The last bias that we're going to cover today is regret aversion. This bias is caused when we are afraid of making a decision that we regret and don't act because of it. This type of bias can come out in many forms, including accepting less risk and holding on to investments that are underperforming. This can lead to not making important investment choices or not selling an investment that is underperforming. In many cases, to avoid risk, what we'll see is that an individual chooses a guaranteed investment option over an investment that may have greater expected future performance. This consequence is that they would have to put more money aside to make up for the reduction in the investment return. One of the areas that would be most impacted by these choices would be putting money aside for retirement. So that's it for today, but join us next week as we explore more of these cognitive biases. Thank you again for listening to Simple Money. If you have any questions, you can send me an email at info@ffcoach.ca, or you can find me on Twitter at @f_fcoach. Take care and talk to you soon.